Hey everybody, thanks for tuning in for another video. Today, I've actually got Allison with Movement Mortgage here with us. Allison, thanks so much for joining.
Thank you for having me.
Definitely. So obviously it's a little bit different than normal. We are on a Zoom meeting instead of being in person, but we're going to roll with it. So, as you know, everything has been sort of in flux, and so we are rolling with the punches, as it were. So I wanted to bring Allison on because everybody's always wondering how the market is. You're probably watching the news a lot more than you ever have before, and the news is telling you a lot of things about what's happening in housing, what's happening with the economy, with jobs. So we wanted to bring some clarity regarding specifically the real estate market, and specifically Houston's real estate market, because it is a little bit different than other places in the country. Even during downturns and recessions and crashes, it's typically a little bit insulated. So there are effects, but maybe not as drastic as what you might see in other places. And then also we wanted to, not from a real estate perspective side only, but show you the difference from a mortgage side. So Allison is the expert in that area. I am not. So I wanted to bring her in so we can answer some questions, and hopefully by the end of this, you'll have a better idea of what the market looks like. Maybe you've been thinking about buying or selling sometime in 2020, then all of this stuff happened and it kind of threw all your plans out of whack. So maybe we can bring some peace of mind, or at least a little bit of clarity, so you can make the best decision for you and your family. First thing, let's start off with, what does the Houston housing market look like right now? So in all actuality, from March's numbers, now remember, we're always going to be a month behind. So when we show the numbers today, this was for March, which has already happened. And so we won't know April's numbers until May. So I think right now it's a little bit too soon to tell exactly what effect the virus has had on the housing market here in Houston. As of right now in March, there was little to no difference at all. In a funny way, actually, there's been a lot of positive. So a lot of, extra sales and higher prices. And so things that we would normally say make a healthy market and are positive, we're still seeing that even in March's numbers. So really there was no measurable effect of the virus in March. Home sales were actually up 11% versus the same time last year, which is mind-blowing. I know, that's crazy. I would not have thought that would happen. However, just from anecdotal experience, we were sort of not seeing very much difference. Closings were still happening, even though they maybe switched to being drive up and stuff like that. But they were still happening, and you're still seeing a lot of homes being sold. So we were hearing from the news that it was just going to crash the housing market, but then we weren't seeing that in real life, which can happen sometimes. But again, in April, we'll have a better idea. So that's really cool. And I think, and Allison, let me know if you agree, I think the reason that we saw everything sort of stay the same, if not improve 11% versus last year, is we still have historically low interest rates.
The truth is, people have to have housing no matter what, right? There are people that are relocating to Texas because of cost of living. So you look at where we're at in our economy and just people not knowing. And so we've seen an influx of relocation buyers too. So between low interest rates and people just being overly conservative because of the state of our economy and relocating or downsizing, I think we're seeing a lot of those things compile into one, which is, it's healthy for Houston economy, and some people it's necessary to just maintain their lifestyle.
And I think a lot of people don't realize, kind of going back to the interest rate, in last year, the average was closer to 4%.
Yeah.
And the year prior, the average was closer to 5%. And if we go back to maybe when our parents were buying homes, interest rates were nuts. They were in double digits. If we saw double-digit interest rates right now, people would lose their minds. But It's funny, they're losing their minds when it's at a 4% or a 3.75, and they think they've missed the boat, that the ship has sailed, they didn't get the low interest rates, they're not going to take advantage of it. Now when they go and get pre-approved and they get a 3.8, they're thinking that that's a bad score. But perspective is everything, right? Context is everything. And I think a lot of people don't have any idea that they're still really low right now.
Mm-hmm. Agreed.
The next thing that we saw was single family home sales were actually up. So when we look at total home sales, we're talking 11%, but just single family, so not including townhomes and condos, those were actually up 8.2%. which means that it was actually the 9th consecutive month of positive home sales or positive increases in home sales. So we even saw the median price go up 4.1%. So median price being the price at which half of the homes sell for more, half sell for less. That actually went up 4.1% to $249,900. And the average price went up too. So average price being went up 3.8% to just under $310,000. So $309,785. So average price is up, median price is up, sales are up. Actually, the median and the average price were the highest ever for a March on record.
Crazy.
In the middle of all of this, right? And we're also seeing inventory is low. So one thing that we talk about when we're looking at the health of the market is housing inventory. People don't always know what that means. That just means how many homes are available on the market. The housing inventory, the months of supply that we have, essentially if no new homes got added to the market and we were just selling what was already there, how many months would it take to sell all of those homes? And so we're still at a 3.5 month supply. This time last year, we were at a 3.8. So we actually have a slightly low inventory. Why is this important? This is important because when we look at the housing crash of 2008, part of the reason why we had that crash was we had way too many homes on the market being sold, and there weren't enough people to buy them. And so you had all these homes on the market. They were way overpriced. People had pulled out equity loans on these houses. So they had a lot of extra debt and they weren't selling them because there weren't enough buyers, and interest rates were higher than they are now and people were making less than they do now. So you have basically the flip of what we have happening is what was happening in 2008. So the reason why it's important to know that inventory is low is, one, yeah, it's good for sellers, maybe if they're thinking of selling because you have less competition, but just looking at the health of the market and whether we can really expect a true crash. There's just not enough homes on the market to satisfy consumer demand. And anytime that there's a supply and demand thing where there's not enough houses, there's too many buyers. People want to buy property. So that helps to prevent a crash because there's still buyers to buy these houses that there's not enough of. Overall, all these numbers, whether you care about the actual numbers or not, what they tell us is that as far as March is concerned, it was a healthy market. And in May, we'll get the numbers for April, and we'll be able to see if there really was any sort of drastic change. I expect to see there were a lot more withdrawals, a lot of people removing their home from the market, so maybe not as many sales, but I don't expect the graph to do this so much as I expect it to dip. And that's normal. And anytime there's a crisis, you would fully expect that there would be some sort of not positive. Maybe we're not going to be setting any records in April, but are we going to be setting negative records? I don't think so. We're still seeing homes sell. So yeah, that's the housing market update. So obviously in March, it was pretty good. So now I want to kind of cover what are you seeing on the opposite end from the mortgage perspective. So maybe before that, you can tell people a little bit about what you do, what your role is, the company that you're with, so people who maybe aren't familiar with you can kind of know where you're coming from.
Sure. Well, first of all, thank you for sharing all that insight. You're so super smart.
It's called notes.
Hey, I like it. You're prepared. So I'm Allison with Movement Mortgage. I've been in the mortgage industry for 10 years now. I am a mortgage loan originator, so I collaborate with my team to help you guys buy houses or refinance. And I have enjoyed my time in mortgages immensely because every client is so different and every climate is different. So we're experiencing that right now. And so it draws a different aspect out of what we're required to do, and it makes us better for it. So it's been an interesting time, and Nick, you can kind of attest to that. But overall, because housing is so essential, regardless of what our economy is doing, we do have to have somewhere to live. We haven't seen as much kind of insanity from a need aspect. I mean, people are still buying and people are certainly still refinancing. And we're seeing 6 to 10 times more mortgage origination than we do on an annual basis. We've seen that in the past 3 months. So it's been a really high peak because of interest rates being low, and the feds are making changes in order to help stimulate our lending environment and get people to continue to feel confident and bolster confidence in buying and refinancing, and it's not just mortgages, obviously other types of debt as well. So we're seeing a huge spike in interest, and people are I think also more aware of what they need to do to position themselves better because of the economy that we're in. So we're seeing lots of people refinance because it puts them in a better position monthly from a budget aspect. So it's been a busy time, and it's been really, really neat to just see people be in a better position than they were before.
Are interest rates still low? What's happening with those right now?
So, it's an hourly sometimes change in interest rates. We're just seeing obviously more volatility because there's so many things that influence the interest rate market. And so one national kind of or international occurrence can influence interest rates. So we're seeing wider swings than we normally would in a normal economy. But we're still sitting anywhere from 3.5% and lower. Today, we could have this conversation tomorrow and it could be slightly different. So it's taking a certain level of pliability from a consumer and from a mortgage lender standpoint of just, being willing to lock in an interest rate and understand that, like, if a more favorable interest rate becomes available while you're in the process of purchase or refinance, we can float you down. There's some.
Well, see, that's important, right? Because not everybody does that. So describe what you just said. So I lock in an interest rate. Maybe I get a 3.8, and you're saying that if they were to drop, movement has the ability to lower that interest rate for you.
Correct. Yeah, a float down policy. And to your point, not all lenders have it, but many of them do. So definitely, if you're in the process or thinking about it, that's a great question to ask upfront is, do you guys have a float down policy in place? Because that essentially would allow you to float down as long as it makes sense. It has to. We obviously don't want to float you from a 3.8 to 3.6 because the cost of that float down for us, because that's a cost that we absorb to get you in at a lower interest rate, is not doesn't make sense. The cost of moving that interest rate is more than the savings that it would ultimately bring you as a client. And sometimes these smaller interest rate fluctuations you're looking at a difference of maybe $10 a month. It's very nominal, but as long as it's 0.25% or greater interest rate that's available to you, we will automatically float you down as long as you're in the process. And typically we have some flexibility, and we try not to let it go anywhere past kind of 5 days before closing. So we have some time there to float it down if a more favorable interest rate becomes available. Because once we start to get to the 5-day mark, that's when we're finalizing paperwork and
numbers and how much you need to bring and all that
coming together. So we don't want to continue to risk you not being solidified with all of your documentation. So but float down policy is the exact wording that you would use as a client if you were talking to a lender.
Awesome. Well, that's really good to know, for somebody who maybe is looking and they're worried that they're, it's kind of like, I think some people sort of think of it like the stock market. Like they feel like they kind of have to watch it and then try to just bid on the market and hope that they get it. But I think a lot of people don't realize it's actually more important to, if the rates are still good, to just lock in so that you at least, if it goes higher, you're not going to have to pay that higher rate. And then you at least start a process. You start understanding how much how much it's going to cost, what your buying power is, and how much down payment you need. And then if they happen to go, 0.25% lower, then you're going to benefit from that, rather than trying to sort of wait on the sidelines and start getting pre-qualified when you see rates hit a certain amount, which for the average person, they can't even really track it that well. But to try to game it like that is just, there's no benefit to you, and you're going to spend more time and effort than you really need to.
I mean, interest rates are like toilet paper. That's probably the best way to think about it right now. They may not be here tomorrow, so like get what you can because they're gone tomorrow.
That's too funny. So when we're thinking about, like, let's give, for example, in the news, Chase came out in March, kind of earlier on in March, and they were like, hey, the new requirement for us is you got to have a 700 FICO score and you got to have 20% down. So is that a specific type of loan that they're talking about when they're making that statement, or is that just any loan that Chase is going to do, that's their requirement?
It is any loan.
Wow.
Any loan. So we will see other lenders follow suit to that, and we have at some level or another, some severity or another. The whole kind of lending environment is based off of risk. How risky is it to participate in lending to people that do have lower credit scores, lower down payments, so on and so forth. And so Chase's understanding is if we narrow our margins to whom we can get qualified, our risk of forbearance or default after closing goes down. So we're going to up our requirements and protect our entities by raising those standards. We have seen other entities do the same. We at varied levels have done the same, but we're also remaining nimble because, last week our requirements for credit scores were 640 on FHA, and now we're back at 620 again because we see that there was an opportunity for us to take on servicing our own loans, which means we can carry that risk ourselves and not worry about trying to sell loans off on the secondary mortgage market. So it's kind of in-depth stuff, but it all depends on the company's ability to bear their own risk and their willingness to bear that risk. So we wanted to keep it risky, I guess.
That's actually, and I don't know if anybody watching this caught that, but that's pretty crazy to think about. That you have Chase, who's one of the largest mortgage servicers in the country at least, and their requirements shot up. And I think that scared a lot of people into thinking, well, now nobody can get mortgages and this is doom and gloom for the whole mortgage industry and the whole real estate. But I mean, yes, they do service a lot of loans, so that is going to have an effect for sure. But I think that for me, when I saw that reported, actually it wasn't in March, it was in April. When I saw that reported, my first thought was, well, that's because people need to be using a local lender, somebody who can still offer them, the requirements still being a little bit lower, better interest rates, better experience. Big banks aren't always the best people to get mortgages from. And they have a lot more requirements, and there's a lot more regulation, and there's a lot, regulation in the sense of they have a lot more things that they have to, meet prerequisites for, essentially. And so that's a great thing that I don't know if people caught is Movement Mortgage doesn't have to match what Chase is doing. Right. Just because Chase wants to do 700 FICO and Chase wants to have 20% down minimum, that's not necessarily reflective of the whole industry.
Correct.
Gotcha. Pretty cool. So you guys are still doing your normal 3.5%, FHA, or 3% conventional, your FICO score still being, you said, 620 on the FHA?
Correct. So government loans is 620. We're still seeing regular conventional loan credit score requirements. I mean, there are kind of more riskier loans that we've temporarily as a company put a hold on. But again, that could change tomorrow. We at this level didn't know that we were going to be, at an originator level. I didn't know that I was going to have accessibility to a 620 product again, at least for the next 60 days. When that became available and that news came out, I was like, oh my goodness, this is so exciting. And it starts from obviously leadership and kind of cascades down. So and it's per lender. So this is our stance and this is what we feel comfortable and how our company is set up to operate. So this is the kind of sandbox that we're playing in.
So what is movement? So one thing that you mentioned was your requirements not necessarily matching what Chase is doing. And then I think you also mentioned that you guys are going to be basically doing your own loans, not necessarily selling them, but you're the one servicing them as well.
Right.
So is there anything else that Movement is doing differently during this time that maybe separates you guys from everybody else?
So I think that, we're remaining obviously nimble in this space and looking for opportunities to be competitive in the market and still service people that need it, no matter what their scenario is, even if they're considered less risky. We want to open ourselves up as a company to still extend help to them. So that's, obviously the greatest thing. But Movement was founded in 2008 during the housing crisis. We were born for times like this. So we're comfortable in operating in this space. And that's exactly why we built out our systems the way that we did, with upfront underwriting to make sure that clients knew upfront what they were qualified for. And some of the other systems and processes that are proprietary to us is because we were built in a time of distress and when the housing industry was non-existent, and we built from there. So we are literally ready for times like these to remain nimble and creative and strong. And
I can see that just in interacting. I feel like I'm kind of getting these constant updates from you guys, like, hey, Movement's doing this and Movement's doing that. And I think that gives a good sense of security, that it's not like you guys are just kind of hanging back and then watching whatever the news says and then just like following suit, but in a way trying to sort of be that torchbearer and try to like be out in front of everything, saying, hey, this is what we're doing to meet demand. This is what we're doing to roll with the punches. And I think that's important, especially right now. It's important to be able to work with somebody that can do that. So kind of dovetailing off of that, let's say you people are going through some pretty rough times right now. Not everybody, but there are definitely people who have lost their jobs, especially in the oil field. We know that 40% of jobs in the Houston area are connected to the oil field in some way. So kind of going off of this idea of talking to a lender and knowing what your options are, I also wanted to bring up this forbearance thing that a lot of people have been hearing about. This actually was back in March. So back in March, there was this statement from Fannie, Freddie, and HUD saying, hey, evictions and foreclosures, we're going to suspend those for 60 days. And then reminding people, hey, you can have forbearance up to 12 months to suspend your payments. And I think a lot of people, especially now, they're scared. They're hearing the news constantly. It's giving them a lot of fear and anxiety. And then they have something like a job loss and, not knowing what to do. I think a lot of people jumped to, oh, well, if I don't have to pay my mortgage, then I'm just going to not pay it, which I don't think people realize the ramifications of making that choice or rent. And we're seeing a lot of reports of that, of like literally people just stopped paying their rent and their mortgages. So one, I want to ask you, what does that actually do? When you do that, how does that affect you? And then two, I want to bring clarity to what forbearance actually is, what it does, and then again, how that affects you. Because I think if people have all the options, they can make the best decision for them. And maybe forbearance does work in a certain situation, but it's not a be-all, end-all cure for I'm not sure if I'll be able to make my payments. And I don't think that should be the first thing people should do. So
I think, you're spot on. I think misinformation is probably our biggest enemy in times like this. We know people need help. 3 million people so far have filed for forbearance. And of that 3 million, I wish I could say that all of them knew what they were getting into. So the greatest disclaimer that I can put over anything that I'm about to share is that it depends on your servicer. So have conversations with them and understand their terms of their forbearance agreement, because not all servicers handle forbearance the same, but 90% of them do. And forbearance typically looks like you putting a halt on mortgage payments for an agreed upon time, whether it's 30 days, 60 days, 90 days, 6 months, or, and as Nick mentioned, even 12 months. Most people are understanding that that forbearance term is just being relocated to the end of their mortgage term, and that they're just extending the time that they were planning to pay their mortgage. And in 90% of cases, that's not what's happening. And in forbearance, typically you are not paying your mortgage over that agreed upon time. And then at the end of the term, you are required to pay it in a lump sum. And if you do not have the funds for it to pay it in a lump sum, plus your coming payment, so if it was 90 days, then you're paying 3 months worth of payments plus the fourth one on that month that it's due. If you're not able to make those payments, and what they're doing is there's a second step after that, and it's essentially agreeing upon a payment plan. And then when they spread out that payment plan, it's not over the 30 years, it is over maybe, if you're lucky, a 12-month period, which then makes your mortgage payment go to a place that's unsustainable anyways. So I saw a lot of that during Harvey with clients, and we were calling people, even though the mortgage servicers that we sold their loan off to after closing, we're calling them and saying, hey, you have mortgage relief options. We were the second phone call saying, hey, you have mortgage relief options, but please don't take forbearance. Like, I know it's a confusing message, but they're required to extend that to the people that they service their loans. And not always does that conversation happen. I mean, when you think of the influx of calls that mortgage servicers are getting right now, I can't imagine them dedicating time to go through all the terms of their agreement with each individual person that's calling in and asking for help. So forbearance looks like that in most cases, and it depends on your servicer. The additional kind of options and all of these words kind of get intermingled. So that's the other thing that I would say is getting clarity with your servicer about how they define these things is going to be the next thing. Deferment or a loan modification are kind of the other avenues that are typically defined the same way. And that's actually when they do take the chunk that's missing and add it to the end of your term. And so you're not having to pay this lump sum at the end of that agreement, which tends to be the more economical outlet for, I'd say, most Americans. So, I mean, we know people need help, but I think that there are also people that, I mean, I've had clients recently. I had a client that was closing earlier this week that at the table, he said, well, I'll just claim forbearance and not have to pay it for a couple of months. I was like, sure, let's have a conversation about that, because he made really great money. He was in an essential field. He's not worried about layoffs or any of that, but he at some point or another believed or was told or perceived that a forbearance just means you get a holiday from making your mortgage payments, and that's not the case. So we want to make sure that we're being obviously informed if we do need that help, because we know people do need it. And also, if you aren't in that position and you're just thinking that you're going to get kind of a break in things, it's not the case. So those are things to keep in mind. I mean, a forbearance, if that is the only option and you understand the terms going in and believe that you and your family can make that work, then 100% go for it. Like, I'm not going to tell you no to getting help, because I know people need it. But most cases, people don't understand what they're getting into. And it can take years and years and years to recoup from things like that. So just want to make sure that you guys are asking the right questions when you're talking to your servicers.
First things first is don't miss a payment. Don't hear everything and say, oh, I'm just not going to pay, because that will not only turn around and bite you, but it will haunt you, because that stuff can ruin your credit score, and it can really have a lot of lasting effects. So the first thing I would say is just don't miss a payment, or don't choose or elect not to pay. If you are going to look for a solution, an alternative solution, do that before you're going to be late or before you're going to start missing payments. Right. So that's the first thing. And then second thing, like Allison said, talk to your lender, your mortgage servicer. That's whoever you're remitting your payments to, and ask them what options they have available, and have them explain their forbearance policy and what that looks like. And I wanted to ask one more piece about, so you did mention deferring. Is that something that all mortgage servicers offer? Or is it sort of like forbearance where it's different depending upon different mortgage servicers? Because it does sound like, I think what a lot of people think forbearance is what deferring is.
Correct.
So how do you either qualify or get deferment, and how can you make sure that if that's something that you need, that's what you actually are getting?
So, I mean, it is going back to a per servicer thing. Not all servicers offer loan modifications or deferment. Most mortgage servicers will offer, obviously, forbearance and then payment plans. Like if you can only make a partial payment towards your mortgage, in some cases, even though you're going to incur, issues on your credit, a blip on your credit for making a late mortgage payment or only a partial mortgage payment, that is a lot better than letting it go for 3 months and then having a lump sum that you're trying to reconcile at the end of that. So those are kind of the two standard options that most servicers offer, but many servicers also offer the loan modification or deferment, and that is when you take that chunk, add it to the end of your term, and just pay out your mortgage a little bit longer. You're literally just shifting those mortgage payments out. So
are there any downsides, or do you we've talked about how forbearance is not maybe what you think it is, and that it does have some negative consequences to it. Are there negative consequences to deferment?
So, you will at some level likely incur something on your credit report that says that a deferment was enacted, but it's a lot better than having a forbearance. It's kind of differently. I will say that even people right now that are looking to purchase, if they have on their current mortgage opted into a forbearance, they are not going to get approved through for a mortgage right now or a refinance. So there's no getting away from kind of the ugly that is forbearance. So definitely weighing out all of your options, having conversations with your servicers, not making super quick decisions without getting stuff in writing to make sure that you are highly informed. I would opt into a loan modification before I did a forbearance all day long, just because I don't have to worry about paying a lump sum. It's a lot more economical in most cases to do that. And even though you're going to incur some type of credit report blip, it's a lot easier to recover from.
I feel like that was pretty helpful. Is there anything that maybe you feel like people need to know from your perspective that maybe isn't getting out there that you feel like would be helpful to speak on?
I think having conversations like this is obviously what people need. I mean, the news and the media, I'm limiting my time with those things because it can get overwhelming, and you are hearing a very kind of marginal representation of what's going on out in our world. And obviously real estate in the Houston economy as a whole is just one of them. So we want to make sure that we're just having proactive conversations. And if there is anything that you are wondering about, obviously Nick is an incredible resource and would give you the insight. He's a wizard. He's, start with him, have conversations with him. And if there's anything that's outside of his wheelhouse, I guarantee you he's going to get you connected with the right people that are experts in their field. So
I would encourage anybody that's watching, if you have questions about the mortgage process, you have questions about loans and how the credit score and all the things that we've talked about that are related to the financial and mortgage aspect of things, that's exactly why I have Allison on here, is that Allison can be that resource for you that you can call and ask questions, and also be able to get more clarity on your specific situation and what it looks like for you. Again, whether you're looking to do something this month or whether you're looking to do something next year, like you gave the example of my client, that's an important thing to know, is even if you're thinking about something in the future, talking to somebody who can give you real numbers is always going to be better to help you be able to plan, to help you. Maybe it's worse than you realize, and now you know, so that you can make changes, you can implement new stuff in your life, make it a life goal for the year, whatever it is. That's what Allison is here for. That's why I wanted to bring you on today, is I want people to also be able to know that they can, connect with me, yes, but connect with you if it's something, mortgage related. And, if they reach out to me, then, obviously I'll send them your way anyways. But yeah, that's what Allison is here for. So I'm going to actually put Allison's information here on the screen so that you have her email and her phone number if you want to reach out to her. And I'll also have mine on here as well. So I think that this was really helpful. Thank you so much for being willing to have a chat with me.
Thank you for having me. It's always so much fun. You're the best.
Thank you. You are awesome as well. So if you've made it all the way to the end, thank you so much for watching. We put out new content every single week. So I try to give helpful tips related to housing, real estate, try to bring on special guests like Allison to hear from the mortgage perspective and other perspectives as well. So if you like this video and you are watching it on Facebook or maybe on YouTube, make sure that you give it a thumbs up, leave a comment. If you have any questions for me or for Allison that you would like for us to answer, definitely comment below, and we'd be happy to either connect with you and have a conversation offline, or if it's something that we can answer that would be beneficial for everybody, then we'll do it in the comment section below. If you know somebody that would benefit from hearing this and having this explained to them, make sure that you share this video as well. And then lastly, again, if you're on YouTube, make sure that you hit that subscribe button because I do put out new content, so that way you can make sure that you're kept up to date to that. Allison, thank you again so much for joining me, and thank everybody for watching, and we will see you guys on the next video.
Bye.